Just before we begin, how many of you are aware that you can already today access lending products using your Bitcoin to get yield on your Bitcoin, whether that's through exchanges like Binance or Bitfinex or OKX, or websites like BlockFi and Crypto.com, or OTC brokers like Genesis? Just by show of hands, how many of you are aware? So most of you for sure. And then how many of you have actually lent on these platforms already in the past year? So clearly this is a very fast-growing, nascent segment of the market. And today what I want to really do is sit down and show you how the growth in this segment has been fundamentally tied to the growth actually in crypto derivatives themselves. So just to start with some terminology, when we talk about crypto derivatives, what we mean is any financial instrument that's tying its value to an underlying asset. So in this case, it would be Bitcoin. And that financial instrument can be either in Contango or in Backwardation. When it's in Contango, it means that the derivative is trading higher than the price of the asset itself. And when it's in Backwardation, it means it's trading lower. So here we just have two sample charts of what that would look like. So on OKX, we have a Contango as of August 21st, and on CBOE, we had a backwardation on January 15th. So that's just something that'll be very important as we get back to this. And getting to crypto derivatives, we've had a massive run-up in volumes and interest in trading on all these exchanges, both regulated and unregulated. And these products are both futures as well as perpetual swaps. So when they're futures, they can be 1 week, 1 month, quarterly, so on. And when they're perpetual swaps, what that means is that they never expire, but there's this sort of a periodic payout that happens based on if the market is in Contango or in backwardation. And as we can see here, the market has been in either backwardation or Contango for the last couple years, and we've seen both regimes happen. And here we see that the historical swap funding, which is the payout that occurs on these products, has been, so green shows backwardation and red and orange show Contango. We can kind of see that there may be some interesting insights that we can gather. Sort of my hope after this talk is that you get a better sense of how these markets are linked, and also some insights into how the yields are actually being generated by these BTC lending markets, by the end borrowers, and also how those yields might give you some insight into where the markets may be going, the sentiment, and also some opportunities whether you're denominated in Bitcoin or in dollars. So, and here's where we really kind of understand that. So obviously we already know that crypto derivative exchanges, the main use case has been speculators, right? People who trade 5x, 10x, 25x, 50x, 100x leverage, get liquidated all day. That kind of is the main use case that these have been mostly known for in the media, at least. But what that liquidity and volume has actually enabled is a whole host of sort of more fundamental use cases of these derivatives. And so thinking about the natural sellers in the market, there's clearly quite a wide mix, but they all have the fundamental thing in common, which is that they need to be naturally long Bitcoin or crypto-related assets. And so this could be in a downturn, people that are hedging cold storage, right? Not a lot of people want to move around large amounts of Bitcoin and KYC out. There's tax issues. There's a whole host of issues. So they may prefer to actually send their BTC to an exchange like BitMEX or Deribit and just short Bitcoin there through a derivative. And that way they lock in the dollar value of their portfolio, and that's very useful for them. So we saw a lot of that activity in late 2018, where people sort of were rushing to send money to exchanges to just short anything they can find. And another would be miners, right? Because these guys are already making massive investments into the space. A lot of them will want to lock in a price when things are kind of a bit shaky, and they're worried that if the price were to go down, they'd be in big trouble. And then third, I have here traders with BTC collateral, but what I mean more broadly is just anyone who needs to be owning Bitcoin collateral to do their business. So for instance, on BitMEX, the only accepted collateral is BTC as margin. So that means that if you want to trade there, but you're a dollar-based investor, you have to actually immediately buy BTC USD spot, but then sell a derivative just to get back to your original dollar position. And similar types of businesses might be like Bitcoin ATMs or Bitcoin-based companies that they need to have Bitcoin to be able to send out, but they don't necessarily want to have the price risk. And then on the natural buyer's end, you have sort of, I have here bulls. And what I mean by bulls is that people who, historically, they're very, very long Bitcoin. So they're not only 100% long, but they want to be 150% long or 200% long. And so in the past, what they might do is get a home equity loan or get a personal loan or a credit card loan. And now with these derivatives, they can instead get that leverage from the market itself without having to go through those systems. So, and then the second one would be Bitcoin borrowers. And so what does that mean exactly? So just to go back in history a bit, so there was an exchange, or a website rather, called BTC Jam. And BTC Jam was actually, from 2012 to 2017, a peer-to-peer platform where you could lend Bitcoins to people based on their reputation, based on what they said they would be doing with the Bitcoin. And it was a grand idea. Ultimately, it stopped. But the problem they always had, and the scale issue they always had, was that it doesn't actually make sense for anyone to borrow Bitcoin. Because when you borrow Bitcoin to do a business, you're basically saying that you can sell that Bitcoin for something and then create something that can actually grow faster than Bitcoin's own network effect, right? And that obviously is very difficult because even when you borrow in dollars to do a business, you may not be able to execute your business, you may not be able to actually get anything done. Whereas now when you borrow in Bitcoin and then Bitcoin goes up 5x, whatever you're doing in the real world probably hasn't gone up 5x. So what that means is that there's actually no real way for people to borrow in BTC and sterilize that price risk, which is the main component when they borrow in that collateral. And so what we tended to see on BTC Jam was that there were a lot of scams where people would try to build reputation on small loans and then finally leave on big loans, whereas actual end user borrowers were too scared to borrow in Bitcoin because they couldn't hedge that risk out. So that's kind of the big innovation with crypto derivatives, which is that now these BTC borrowers, what they can do is they can access that pool of people who want to yield on BTC. They can sell that to fiat and then pay off electricity costs, expenses, salaries. And at the same time, they can hedge that out so that even if Bitcoin goes up 10x, they can still return that capital to their lenders. And so here we have a host of different borrow markets, some of which I mentioned in the beginning. Basically, you have a wide range from both retail platforms where they're trying to gather BTC, USDT, ETH from retail customers, and sort of down to institutional where they would actually, a lot of them, be net borrowers from these platforms, these retail platforms, and also be dealing with whales and sort of thing themselves. And what they'll naturally net lend to will be people that are actually doing the basis arbitrage in the markets. And what I mean by that is they'll be looking at the level of contango and backwardation in the markets to decide the yields that they're willing and able to borrow various crypto assets at. So here we see on the left, from Genesis's quarterly disclosures and reports what their growth in cumulative originations is in dollars. And then on the right, we have BlockFi, which is a retail platform where you can actually go and lend out your BTC, USDT, I think GUSD they support. But here you see sort of straight line growth on both. And that's actually been a trend since mid-2018 or so. And in terms of backwardation, this is something that I think was sort of the big driver of a lot of the capital starting to flow into these sites and sort of what was happening to fuel that growth. Because what tends to be the case that we see in crypto markets is that the market is structurally in contango because people generally want to buy more Bitcoin because we're all here because we're generally bullish on something or we think we might be bullish on something in this space, right? So backwardation occurs when sort of all those bulls that were on 1.5x, 2x leverage, they kind of, they thought they were safe. They thought, people would support 6K, and then it turns out there was just not enough buying power at that time. So, we had that big crash from 6 to 3K almost in Q4, and the markets went into huge backwardation. The reason being that on top of all the bulls being liquidated, losing not only on their position, but also on the Bitcoin that they own, you also had all the miners get really scared and start hedging. You had people in cold surge being like, I want to lock in some value. And so that sort of crushed the entire curve, right? And what that kind of tells you is that it's a period of max pain and also max fear, right? Because even though the market is now paying you to be long Bitcoin, you still don't want to do it because you're scared it might go down to 1K or it might be all dead. Maybe mining debt spiral was something that people talked about when the market was at 3K. So that has some interesting implications, because what it's telling you actually is that the derivative markets are willing to pay you to be long, and as a result, the borrow markets will also, the yields will go up a lot. So at that time, BTC lending rates went over 15% actually, meaning that you would, if you lent 100 BTC out for a year there, you would actually make 15 BTC just from the way that the derivative markets were behaving from the hedgers. And that's something very similar actually to what we see in base metal markets, right? When we have big collapses in zinc prices or nickel prices, those markets also go into deep backwardation, where the big dominant hedgers, they're just like, we have to lock it in or else we'll go bankrupt. We have to just fix that price in. So very similar analogies you can make to base metals. And so here, just some more charts for you. We can see that at some point it went to annualized discount of 20% on the futures, and that kind of coincided with the fall in price as well. So on the flip side of backwardation is Contango, right? And Contango is really talking about how the future is actually trading above the spot. And we said before that that's a very natural thing for the market to be in. And if people are using BTC collateral to buy, then as the value of BTC USD goes up, they're actually getting rich very fast, right? Because not only is their BTC going up, but their position is also in the money, and they have more buying power from all these platforms that are denominated in BTC. So what we've seen with every parabolic rise is a massive expansion of Contango. And if you think about it, it kind of makes a lot of sense, right? Because the pool of people doing arbitrage on Contango and sort of trying to get dollarized yields, that money is not increasing when Bitcoin doubles. But when Bitcoin doubles and all the leveraged longs are making a lot of money and they want to buy even more, the extra dollars to flow in to sort of provide that liquidity and that leverage for them isn't there. So Contango can spike out very, very fast as a result. And we've seen that in pretty much all parabolic advances since late 2017. So whether it's bullish or bearish is an interesting question that people often talk about. A lot of traders talk about this nowadays. And I think after the fact, all local tops, medium-term tops, have been marked by very high Contango. But in the process of that Contango building, you don't know if that was the top. So that's kind of an interesting way to think about. And that makes sense because at the very top of every local market, like we've had with the 14K run in mid this year, it was very interesting because the market was extremely leveraged. The sort of rates that people were willing to borrow dollars at to keep their long was incredibly high, and which means that, and the market wasn't going anywhere. So what it means is that the spot sellers were sort of overpowering the leverage buyers, and we'll get into that a little more on the next slides. So here we see that in DEC 2017, the annualized premiums went over 200%, right? Which is absolutely ridiculous. But when you talk to people from back then, they would tell you, well, the market just went up 4 times. So I'm rich from borrowing at 200% to do this. And my credit card loan, yeah, I can borrow at 15%, but here I can buy it on 10 times leverage. And maybe I bought the breakout of 6K to 20K. So for a lot of these borrowers, they actually don't think of it as they're being arbitraged or they're paying away a lot of money. They think of it as, do I think Bitcoin will go up more than the interest payment that's happening? If yes, then it's a buy. If not, then no. So that kind of shows you just how the euphoria in ICO places is also very much active in crypto derivative markets. And then June 2019, as I was discussing, the premiums again went very, very high. So basic conclusions that I think could be drawn from a lot of this is that if you're a dollar-based investor, this is actually sort of all the reasons why things like DAI, USDT, USDC have a borrow rate that's much higher than the risk-free rate that you get in your bank. The reason is actually because a lot of crypto speculators would love to have your fiat to be able to buy more crypto with, right? And that's something that is important to understand, because as these lending markets have come up, a lot of people think, well, with these high rates on DAI, at 18, 20%, with these high rates on USDT from mobile wallets at 12, 13%, there just must be a lot of Ponzi going on here, or there must be a lot of unsustainable behavior going on. And actually, if you look at what's driving these rates, it's not at all. And these rates have been seen in other emerging markets as well as they grow. Some of the emerging market currency that my firm is very active in the past on NDFs. In Asia, very regularly, dollarized yields can go to 15% for 3 years, right? And that sort of is your payment or for being involved in crypto and watching these things happen. So conversely, if you're a BTC denominated investor, you can also get some yield from people doing this trade. Whenever market goes into backwardation, they'll want to borrow your BTC. And essentially, you should be getting paid something for being willing to be long Bitcoin when no one else is, right? And if you're someone that wants to trade occasionally, I think there's some interesting signals that these markets can show you where sort of all long-term bottoms now have been marked by backwardation, where we have hundreds of millions of liquidations on BitMEX, we have hundreds of millions of liquidations on OKX, and as a result, that sort of represents max pain, right? And conversely, if you're into scalping it around, a lot of local tops nowadays have been marked by extreme over-leveraged buying at resistance. So let's go to questions now.
Hey there, thank you. Anthony Lewis from R3. Thank you very much indeed. That was very interesting. I have a couple of questions. You talk a lot about the returns and the yields, but you didn't touch that much on the risks. Like, where's the money going? Where do you think the risks are ending up? I know some of the dollarized money is going into kind of peer-to-peer loans and things like that, and they are quite high risk. And at some stage, you're not going to get those returns, right?
Yeah.
Can you talk a little bit about where the money's ending up?
That's a great question, and I think that there's a big fragmentation that's occurring now in the borrow markets, where what is the end collateral being used for, right? So today, what I've mostly focused on is sort of the highbrow, the correct usage of crypto asset capital. That's BTC, ETH, USDT for the most part, and how that's being borrowed by proprietary trading firms like ourselves. Where we are looking at where the derivatives are trading relative to spot to decide what rates to borrow collateral at. You bring up a very interesting point, which is that with this sort of growth in legitimate borrowing, there's now been a lot of, we all know that things like BitConnect and things like MLM schemes, they all promise interest, right? And they all say, just give us your capital and we'll give you 10% a month or 20% a month and these kind of things. And there's now a space in between that, which is semi-legit, where what they're actually doing is they're taking that BTC or ETH collateral and they're selling it down to dollars and then actually buying the curve regardless of the rate makes sense or not, and then lending it in P2P markets that are under collateralized, right? And so they're making that yield spread by essentially taking your money and lending it to random people. And that's something that definitely some systemic risk there. And I think earlier this year we had a default of 6,000. We saw the default of 6,000 BTC happen from that in onshore China with some of these borrowers and lenders who they ended up not being able to pay it back because the money is just not there, right? And so I think it's really important that if you do end up checking out the space, that you understand how those yields are being made. And often, for some of the legit providers in the space, they have this issue where they cannot match the rates of the non-legit ones, right? So a good example is like if you see a rate being very low on one site and very high on another, you may want to ask the one on another, how do you actually make that rate? Why can't BlockFi pay me that rate? Or why can't Celsius pay me that rate? How can you pay me that rate? And that kind of will sort of shed some light onto what they're actually doing with your money.
We got some more questions out there. Yeah, in the back, in the white shirt. Thank you very much.
Sure, I've got loads more.
Get ready.
So in terms of systemic risk, something that I'm worried about, I don't think people are worried enough about systemic risk. A cascade, I think coins are being lent and relent and relent. And somewhere, I think the word is rehypothecated. And somewhere, someone's going to be unable to pay. And I have no idea who's going to be harmed when that happens. So do you have a sense of what would trigger an alarm bell for you? Do you have a sense of the size of the systemic risk, or what are you concerned about?
Yeah, so I think the reality is that all this capital ends up on exchanges, right? Because to be able to generate these yields, you must be doing something with the money. You can't just take it, put it in cold storage, and then pay interest. It makes no sense, right? So by definition, there's an element of risk in all these activities. And even when it's a fully collateralized loan, the markets can move very fast, and then the collateral is not enough to cover what you've lent out. So with that being said, I think that this kind of whole industry relies on the fact that the top tier crypto derivative exchanges are sort of very solvent and very good at protecting customer assets. And that, I think, is the biggest systemic risk. I think reapplication is something that people bring up a lot, but in practice, what has been generally happening is that people are lending as principals for the most part. So they're lending their own capital. They're lending their own, Genesis, they lend a lot of their own capital. Blockchain.com, they lend a lot of their own capital. So for them, it's not that much reapplication really happening because they're simply sitting on billions of assets and they want to get some yield on it. I don't think it's gotten to the point where there's massive short selling, for instance, on weird coins. That there's the mass majority of activity is on BTC and to a lesser extent USDT and Ether. There's not a whole lot going out. When you go further out, if you want to borrow Tron, for instance, right now, you just can't do it, right? There's no one that has it that will lend it to you. So that's the kind of thing where I think it's been overblown, the rehypothecation risk. I think there's not that much relending and relending going on, just because the rates, there's just not that much juice in it. I think that there has been a spring up in sort of intermediary brokers where they know the whales that want to lend their Bitcoin and they put them in touch with people that want to borrow it to do activities. And so that I think gives people the sense that there's a lot of relending going on, but in reality, there's really not. So.
Okay. Anthony, you said you had a bunch of questions. Do you want to get one more off? Yeah. We will give, I do have a couple of hands up. I've got one right down in front here. And then I've got one in the back. I think George is up for another round. Wait, where's my man with the mic? Oh, looks like he's going to George first. Don't worry, you're on my list. Thanks.
That was a super interesting presentation. Thanks for that. So you mentioned some of the decentralized projects as well that do lending.
Yeah.
What would you see as some of the differentials there in yield versus something like the Bitfinex CFD lending, which has quite a wide history? I mean, it's been around since 2012, something like that. So, and as far as we know, it's fully collateralized in that Bitfinex choose the markets in which to do lending on. So if there was some sort of massive black swan event, it's basically on Bitfinex to make sure that they cover that. Although it's been 8 years, there's been many Bitcoin crashes in between, and it still seems that lending is holding up. So what do you see really as the, is there any sort of interesting plays there between a yield on something, say, centralized like the Bitfinex lending order books with the CFDs versus, say, Compound or one of those other different projects? And do you see any relation there when the market goes up or down?
Yeah, that's a very sort of advanced kind of concept, but essentially what he's saying is, you can lend your ETH mostly and your USDC DAI on decentralized platforms like DYDX, Compound, and so on, Nuo as well. And these sites are using smart contracts essentially to validate that collateral is there and to perform liquidations as needed if the market moves, right? Those markets have grown massively in the past few months, and Compound now has over 30 million USDC, I think, 30 million DAI or so. But I think that the rates there will generally be different than the rates you often see in centralized markets for a couple reasons. One is that the type of people that generally use those platforms have a certain skew. So a lot of them are trying to borrow DAI, and they're really looking at the rate that Maker stability rate is showing. And so if that rate is high, and then they can borrow at a lower rate on Compound, they think they're making money because they're comparing it versus what they would have been paying on Maker, right? Whereas in the derivative markets or in the centralized markets, these people wouldn't have such a naturally bullish view on Ether, for instance. So they would, so you tend to see that when the market's a bit bearish, somehow people are still willing to borrow dollars, dollar stable coins on these decentralized platforms, even though they really shouldn't be. They should just be buying centralized derivatives. I do think that as those protocols get better and the UX gets better, the liquidation fees get lower, and the leverage goes higher, more importantly, you will see a lot more adoption there. Right now, the big issue still, though, for a lot of users is that on Maker, the leverage is about, I think, 1 to 3, and I think on Compound, I think it's 1 to 5. Might be wrong, but on BitMEX, it's 100x, right? So that alone, it takes away a lot of the point for some people because they might say, why would I take, I have to really believe that these Ethereum smart contracts are adding a lot of value to my life. relative to just like trusting Arthur and giving him the money, right? So that's a big part of it. And then secondly is that some of these smart contracts like Compound, they only recently have people really started to look through the code and say what is actually going on here. And now recently people are saying in fact that there are admins with custody rights and there are a lot of issues with how do you actually do it and who are the oracles for the liquidations. On top of that, liquidation fees are a huge problem in the whole decentralized lending space, right? If you get liquidated on Maker, that's a 13% fee that they take on you that goes to the holders of the Maker token, basically. And so that's kind of an absurd fee, right? Like, why are you paying 13% of your collateral when you get liquidated? And so as those fees are still quite high, they're making a bet that people will value decentralized lending far more than just much cheaper, much more high leverage or like other forms of leverage. So.
Woman in the front, I think I said, did you want to put your hand back up so the man running the microphone? Oh, you've got it already. Okay. I don't know why. I'm going to get him to you. Don't worry. I'm going to bring it to you myself. Go ahead.
Okay, so quality presentation here, Zoo. Good insights that you've shared. So you shed light on what happened in December 17 with CBOE and CME coming with their future launch and what effect that had on sort of the reversal pattern in the markets. What I'm seeing a lot right now is that there's fear around the backed futures, right? Like September 23rd. And without asking you what you believe the markets will do, because that would not be a fair question to ask you, how do you believe that this backed futures event differs from the CBOE and CME event at the end of 17 at the top of the bull market?
I think CME and CBOE was there were very hurried launches to capture the hype cycle, right? So the market sort of really was anticipating those and tripled into it, and there's a lot of hype around it. And them actually listing was a classic sort of buy the rumor, sell the facts, right? Where the days that they listed nearly marked the high of the entire market, right? And so I think with Backed, we're clearly in the middle of that range versus all-time high, right? We're about 50% off from all-time high. Sentiment is very low still in terms of the retail. If you look at sort of daily average users onboarded on some of the major exchanges like Coinbase or Bitstamp, it's not really going anywhere compared to 2017 where it was like 100K a day on some of these sites, right? So I think that's a huge difference versus at that time. I think with Backed, the leverage is low. It's similar to CME and CBOE, but the leverage is low. I think it'll be a lot of people buying for physical delivery, actually. So they'll actually be getting real Bitcoins. And that's a big difference versus cash settled. So these are people that they actually want to receive the Bitcoins from the warehouse. So I think what Backed actually really could disrupt is ODC brokers, because what it means is now that market has gone from a sort of more fragmented market where you check with a few brokers, you get a price, to sort of an all-to-all market where electronic market makers, HFT firms can provide a very tight price on Backed for the one-day future, and then you could just buy that and then get your Bitcoin the next day. And you don't have to worry about KYCing with that broker. You don't have to give them your ID. You just have to have a futures clearing member that will clear your trades on Backed. So I think it's quite different as a product and as a scope to CME.
Okay, and I did promise this woman down in front we would get the microphone to her. She's ready. Yes. Okay, here he comes.
Hello. Okay. So I actually wanted to build on the question and answer that you had with Anthony, and specifically about that you felt that there isn't enough rehabilitation happening in the market. So if you look at the traditional borrowing lending markets, the way those yields work is essentially underpinned by the actual use of the funds that are being borrowed, which typically goes into building businesses, which is where the end of the day all of that comes from, the yields come from, right? But the way I look at it right now in the Bitcoin, Ethereum markets, and the crypto markets in general, none of that is actually happening. You're not borrowing to actually build businesses because the market isn't there yet where you can do everything, pay all your costs in those cryptos. And so essentially these yields that are coming are leveraged returns coming only from trading requirements. Like the end use of that collateral is only and only trading, nothing else. And then you borrow, you use it for some kind of trade, and then whatever you get out of that trading, you again use that for the second layer of lending. So essentially, until the time, because of the margins that get cut each time, you can go down with the same one Bitcoin. You can use it for like 10 rounds or like 20 rounds, depending on where your margins are for each round of lending. So basically, it's just financialization which is causing all of this. And at the end of the day, how long can that continue? It's only until people believe in a certain direction of the market. At some point, that's going to start come crashing down. And I think that's the kind of systemic risk that Anthony was referring to. So you being in the center of it, what do you think?
I think that's it's kind of a misconception to think that the markets are all being borrowed and lent purely for speculation. I think one of the things I wanted to show today is that with the maturity of this market, there is now a lot of working capital use cases that are being used. Genesis is sort of at the forefront of this whole thing, right? Where they sort of, in the beginning, it was a lot of, there's only a few companies that can actually borrow in Bitcoin because they can expect a revenue in Bitcoin, right? So these would be exchanges, these would be miners, these type of things. And so like one trend we're seeing now, for instance, is that like BTC miners, they actually want to borrow USDT to pay their electricity instead of sell their Bitcoins because they're very bullish into halving. They think we're going to go to 40K, 50K. So that's one example where even though it is speculation, it's also a choice of denomination, right? And so it's like some Bitcoiners might say, if you own fiat, you're also speculating because you think it's going to outperform Bitcoin. So speculation itself is kind of a misnomer almost. It's sort of as we collectively grow this asset class and grow adoption of Bitcoin, I think inevitably it becomes used in a sort of permissionless way as collateral for people. And so that's what we've seen emerge. It's not on a fundamentally frail sort of grounding because at the end layer, it is still primarily Bitcoin whales, Bitcoin holders, Ether whales, and they're lending out their own money. So at the end of the chain, they will lose their money if they lend to the wrong people. And that has already happened well over time. There's a number of cases in China, for instance, that have been documented. And so they're taking risk and they're receiving reward when they're right and they're receiving loss when they're wrong. No different than 2,000 years ago on the Silk Road, right? On the Silk Road, you think this merchant is good for it, you lend him some money and turns out he didn't come back with the salt or he didn't come back with it. So that part of it I think is relatively healthy. In terms of rehypothecation, I think it just looks that way because there's a lot of these retail platforms that are all with different rates and a lot of these intermediaries and people are imagining that one Bitcoin is getting lent 5 times, 6 times, 7 times. I think that even when that happens, there's always a layer of collateralization that happens, right? So if someone is a very good credit, you may lend to them uncollateralized. If someone is a very bad credit, you can lend to them but 150% collateralized, right? And so on all the DeFi, decentralized platforms in Ethereum, all those are being run fully over-collateralized, right? 150%, 130%. So there, the risk is almost nothing because it's just a liquidation risk. When it's under-collateralized, at each point in the chain, there's someone taking principal risk that is a loan they want to make. No different from the current markets. The current, if you take a credit card loan, someone is making a bet that you will pay back based on your identity. So
100% agree with everything you said. Just that I'll draw a distinction, a slight distinction between speculation and hedging.
Yeah.
And the example that you specifically gave about these whales who lending their Bitcoin out and taking USDT to manage their. So that makes complete sense. But one, that's not speculation per se, because you're literally hedging your underlying out. So that's a hedging use case, which we see everywhere. A certain amount of speculative stuff built into it in terms of which direction you see the market moving in. But the question is the borrowers on the other side. What are they using that Bitcoin for? Like my question is, I don't see, and I would love to hear being corrected, if they are using this for building businesses rather than just pumping it back into BitMEX for collateral to be able to speculatively trade on it.
Yeah. So So basically the big growth in lending has been fueled by derivatives because now people can sterilize that price risk, right? So a big part of it is fueled by people borrowing to arbitrage on exchanges and to create liquidity in BTC. There are also people borrowing to use as working capital. And that in each case of that, there is a credit that is being given, right, by the lender. And I see that as no different than any other investment that's ever occurred in the world, where there's a risk and a return. So I don't see it as systemic in any way, just as I don't see it as systemic that credit card debt is a risk. I do think that the major risks are some centralization risks surrounding where this capital all goes to get a yield. That in my opinion, is where the real risk is, because you need BitMEX to be good, you need OKX to be good, you need these venues to sort of be good for the collateral, because otherwise, suddenly a big pool of capital can be wiped out in a moment, right? We have a big hack of an exchange, if we have a big, so there I see a lot of risk. I think a lot of like other big risks are like huge price moves, right? Like if Ether USD dropped 80% in a day, like that would for sure be a huge problem, right? For a lot of people that had been taking Ether collateral and lending out dollars for people. So I see huge price moves as a big risk, and I see centralization of collateral where people are trying to generate these yields from borrowing as a big risk. For the working capital use case, I don't see it as a risk at all. I just see it as lending. And then for sort of the reapplication, I just don't think it exists, actually. I don't think it's happening in the way that it's dangerous, at least.
Thank you so much.
All right, that's great. A lot of questions. This room is filling up. People are getting into it. Thank you so much, Sue, for giving us that great presentation and taking these questions. Great job. Thank you very much. Sue from 3 Arrows Capital.